Good morning, everybody, and welcome to our webinar today, Living the Best of Both Worlds, in association with the Britain-Australia Society and the Australia-UK Chamber of Commerce. We're going to go through various different aspects today, and I'm joined by a few different people. One is Alan, and he'll talk to you about tax today, and then James will talk to you about inheritance tax, etc. On that side. And to start with, I'm just going to hand over to Louise from the Britain-Australia Society, who's going to just give you a little bit of an introductory talk. One thing I will say is that we'll have questions and answers at the end of the presentation, so there is a Q&A box rather than the chat box, so if you can leave all your questions in there, we will get round to them at the end of the presentation, so stick around for that at the end. So I'll hand you over to Louise now.
Hello, I'm Louise Mully. I'm the National Director of the Britain-Australia Society, and we would like to welcome all our many members and friends who are here today, as well as all the other people who've tuned in, because this is a collaboration that we've done both with our corporate partner, BDH Sterling, and also for the first time a collaboration with the Australia-UK Chamber of Commerce. So welcome, everybody. I think that post-pandemic, many of us have had pause for thought about the issues that we might face from a tax, financial, pension planning point of view if we were considering splitting our time between two jurisdictions, and in this particular case, Australia and the United Kingdom. The shape of the world is very different now, and so we thought it would be a very useful thing to put this together with a team of experts assembled by BDH Sterling to look at the variety of issues which you need to consider if you're thinking about splitting your time between two jurisdictions. And so I'd like to hand it over to the experts. Thanks very much.
Yeah, thanks, Louise. And so, as I said, there's going to be three main presenters today: Alan from BDH Tax, James from Hall and Wilcox, and then myself at the end to talk about the financial planning aspect of things. So, first of all, I hand you over to Alan, who heads up BDH Tax and is a duly qualified an accountant. So he'll take you through a few sort of tax things that you need to consider.
Thank you, Paul. I only have a relatively short time today to discuss the subject of tax residency. So this will be a very quick run through of the subject at a high level. If any of the issues I mention here appear relevant to you, please feel able to make inquiry of us through the form at bdhtax.com or call our office in Epsom. For those who are not internationally mobile or who have not moved between countries, the concept of tax residency is unlikely to be an issue they've ever considered. However, underlying the taxation of income and capital gains is the concept of residency. As a general concept, as a general principle, if you're tax resident in the UK, you're subject to UK tax on your worldwide income and capital gains. But this is subject to the question of your domicile, which I'll discuss shortly. If you're not tax resident in the UK, you are broadly only subject to UK tax on income and gains that arise from real property in the UK, such as a residential property. If you're tax resident of Australia, you're subject to tax in Australia on your worldwide income and gains, subject to the question of whether what are called the temporary tax resident provisions can be accessed. I'll discuss the temporary tax resident provisions as well. If you're not resident in Australia, you remain subject to tax in Australia on income from property in Australia from which you receive rental income. So it's possible to be subject to tax in Australia and the UK if you have income from, say, a rental property in one country while you're living in the other. Your domicile for tax purposes is relevant for income tax and capital gains tax, as if you are resident in the UK in a tax year and do not have a UK domicile, any foreign income or gains that are not remitted to the UK are capable of being disregarded or not taxed in the UK. So at first glance, this might seem very attractive. Why doesn't everybody who's resident in the UK and who has a non-UK domicile adopt the remittance basis? The answer is that adopting the remittance basis of tax means the loss of the UK personal allowance for income purposes and the annually exempt amount for capital gains. The loss of these allowances may not be important for those on higher levels of taxable income, £125,000 or more, as the UK's personal allowance is fully tapered away at this level. A further financial disadvantage can arise once you've been tax resident in the UK for 7 tax years in the last 9. In this circumstance, a remittance basis charge of £30,000 becomes payable if the remittance basis is to be adopted. In other words, once the remittance basis charge becomes payable, the UK tax saved by adopting the remittance basis must be at least £30,000 for the adoption of the basis to be worthwhile. And the remittance basis charge increases in amount the longer you are resident in the UK. So what is domicile? We're all born with a domicile of origin. This is usually where our father was born. We can acquire a domicile of choice by moving to a new jurisdiction, for example, moving to Australia, with the intention to live there permanently or indefinitely. And we acquire a deemed UK domicile if we're resident in the UK for 15 out of 20 tax years. Note also that if you have a UK domicile of origin, you were born in the UK, have acquired a domicile of choice elsewhere, for example, in Australia, and become tax resident in the UK again, your UK domicile of origin is revived and you can't make use of the UK's remittance basis of taxation. So quickly on to tax residency in the UK. The UK has what is called a statutory residency test. This provides a measure of clarity as to when you are and are not a tax resident of the UK. The statutory residency test is a subject on its own, and there are too many details to discuss in the time available today. We have a flowchart. If you're interested, would like to see our statutory residency test flowchart, please contact us through bdhtax.com or our Epsom office, and we'll email that to you. Residency in Australia. Firstly, a caveat. The Australian government is considering a change to the tax residency rules in Australia. From what we have seen thus far, the changes appear to be similar to the UK statutory residency test, but they may change again before they become law. Our present expectation is that if these changes are introduced, they'll come into effect on the 1st of July 2023. But we have a federal election in the offing, and the new parliament may well have a different view and different priorities to the current one. So through the current residency provisions in Australia, we start with a resides test. Do you live in Australia? If you don't live in Australia, are you domiciled in Australia? And if you're domiciled in Australia, do you have a permanent home outside Australia? We then look at the 183-day test. Have you been in Australia for 183 days or more during a tax year? If you have, is your usual place of abode outside Australia? And do you have any intention to live in Australia? Finally, less commonly, there is a Commonwealth superannuation test. Are you contributing to the public sector or Commonwealth superannuation schemes? The Australian Taxation Office has issued tax rulings that discuss situations impacting residency. These being, next slide please, Paul. These being ruling 98/17, which discusses the residency issues affecting new arrivals in Australia. For example, migrants to Australia. There's ruling IT 2650, which discusses the situations when a person who is domiciled in Australia chooses to live overseas for a period of time. So now a few words about the special tax exemptions available to those who are resident in Australia and who can satisfy the temporary tax resident provisions. These exemptions can be valuable in that a lot of tax can be saved. The key requirements are broadly that the taxpayer is the holder of a temporary residency visa and does not have a spouse or de facto partner who is an Australian citizen or permanent resident. Holders of various visa types are commonly able to access these exemptions, including employer-sponsored 457s and 482 visas, business owners and investors under subclass 188, and many New Zealand citizens and their partners. So what makes the tax exemption so valuable? If you can meet the requirements, the following are not taxable in Australia. Foreign income, such as income from rented property outside Australia, and dividends and interest from investments located outside Australia. Capital gains on the disposal of investments outside Australia, such as the sale of property or the sale of a business interest, and capital gains on the disposal of investments in Australia, so long as the underlying assets are not real property in Australia. Years in which we've been doing tax work, we've helped many individuals who have moved to Australia from the UK on temporary visas who have sold property and businesses in the UK with significantly reduced tax bills. The timing of disposals is key. So on to tax treaties. It might be apparent from what I've said already that under the domestic provisions in each of the UK and Australia, you can be tax resident in both countries. The tax treaty between the UK and Australia contains provisions in Article 4 which discuss where an individual is to be treated as resident. These are known as the residency tiebreaker provisions and comprise the following. Where is a permanent home available? If there are permanent homes available in both the UK and Australia or in neither, where are personal and economic ties closer? This is called the Centre of Vital Interest test. If that's not capable of being determined, is the taxpayer a citizen of the UK or of Australia? If neither or both, then the matter is passed to the ATO or HM Revenue to make a decision. Once you've established where you are resident under the treaty, we look at other articles in the treaty to work out how your income or capital gains should be taxed. For example, the treaty provides that pension income is solely taxable in the jurisdiction in which you are a resident, subject to a consideration of Australia's temporary resident exemptions. Rental income received from a property in one country is taxable in both countries if you're resident in the other. Salaried income received from an employment is usually solely taxable in the country where the employment is exercised or carried on, given the employee is resident there. Sale of properties. An issue we see regularly is the sale of property in one country when the owner is living in the other. In this regard, we're looking at capital gains in the country where the property is located and capital gains in the country where the property owners are resident. Another situation we're often asked to look at is the timing of the sale of a property when a person is planning to move to the other country. For example, should you sell a property while you're resident of the country where you're living at the moment? Or should you defer the sale until you're resident in the other country? There can be significantly different tax outcomes resulting from the rebasing of UK residential property to its value at the 6th of April 2015, if it was owned at that time, and is sold when you're not tax resident in the UK. This is particularly valuable when a property has been owned for many years. The pre-April 2015 gains are washed out from the charge to UK capital gains tax. The rebasing of the value of a UK property is relevant to the value when you'll become a tax resident of Australia. Subject to arriving in Australia as a temporary resident, when of course the sale of the property is exempt from the charge to tax in Australia. Also valuable is the potential to access Australia's 6-year CGT exemption when a former main residence is used to derive income and is subsequently sold. Watch also the abolition of the CGT main residence exemption in Australia if a former main residence is sold when you're not resident in Australia. This can be a particularly punitive measure. So if a property has been owned for a number of years, it was your main residence when you lived in Australia, and then you move overseas, If you sell the property while you're not residing in Australia, the entire capital gain becomes subject to tax, the capital gains tax in Australia. So I fear I'm out of time. That's been a very quick run through. I hope this has given you a flavour of some of the issues which we often encounter when people are moving between the UK and Australia, some of which may be relevant to you. As I said at the outset, please feel able to contact us at BDH Tax for a free initial chat if you think you might have some tax issues that need looking at by a firm that is experienced in both countries. Many thanks. Back to you, Paul.
Thanks very much, Alan, for that. Obviously, all very useful stuff, but you're just scratching the surface, really. If you've got any specific questions about anything like that, it's definitely worth getting in contact with BDH Tax and discussing your personal circumstances and seeing what they can do for you. So I'm now going to hand over to James, who's going to talk a bit more about estate planning for you. So James is a solicitor based in Sydney, I'll hand over to him.
Thank you very much, Paul, and thank you, Alan. Yes, so I'm going to talk about estate planning and some of the unique challenges it poses where you spend time living between both countries, often with assets and in both countries. And common things are looking at whether you should have one will to cover everything or separate wills. And some of the common things that we see there in terms of triggers for you. If I could ask you to move on to the next page for me, Paul. Thanks. And also be talking about inheritance tax as well. So just sort of moving through the slide on this, so looking at estate planning, why to do it, so the importance of having a will and what happens when you don't. So a lot of people don't realise when you die without a will, you die intestate. And whilst that has the right outcome in some circumstances, in blended family situations or say where people are married, it can lead to different outcomes. So an example would be in Australia, for example, and we treat de facto relationships the same as being married in terms of intestacy, and normally your estate would go to your spouse. Whereas in the UK tends not to treat de facto relationships in the same way. So I had a client whose spouse died, de facto relationship, and it actually ended up all the UK estate going to his parents rather than to her. So it was a very sad outcome. If we could just keep on flicking through these points, Paul. And one of the things we also look at is superannuation. So similar to UK pension, superannuation, there is more of an estate planning tool in Australia. So you can leave it to your family, but we need to think carefully about how do we leave it in the most tax effective manner. And sometimes we leave it to a spouse and children outright, and other times we leave it through the will, through a more tax effective structure there. Moving to the next point. So the other thing to think about as well, so it's very important that you put in place a will, and I'll talk about shortly whether you have a worldwide will or separate wills. We also need to think about having documents to cover loss of capacity. So in Australia or New South Wales, it's called an enduring power of attorney for financial and legal decisions and to sell property, to operate bank accounts. But that only applies to Australia. You can't have a worldwide power of attorney. You should have this equivalent, which is known as the lasting power of attorney prepared in the UK that can cover those decisions. So it's important that's not forgotten about. Keeping moving forward, thanks, Paul. I'll talk about UK assets and the issues around them, but if we can move on to the next slide, so I can just talk through that. So I mentioned before the consequences of having no will, but even if it may lead to the right outcome, it tends to take longer to administer where you have no will because you have this intestacy, and tends to sometimes be more expensive to administer. So it's more important, even if you have a simple will, to make sure your intentions are achieved and you can get things done efficiently. One of the things we often see are people having out-of-date wills. So it may not cover all your assets. Typically, for example, if you had children, it might miss out children, and there may have been circumstances changing, moving countries, and not covering those. And these days, at least in Australia anyway, typically often will recommend including at least the option of a testamentary trust and a will. The reason for this, in a nutshell, is primarily twofold. So one is tax planning, in that the beneficiary, who is often the trustee, gets to split income tax and capital gains tax amongst their family to save tax rather than paying it in their own name, which is particularly relevant if that beneficiary is a higher rate taxpayer. It can be used to help children or grandchildren with things like school fees and other costs like that, but also asset protection. If you've got a beneficiary, say a child of yours who is in an at-risk role, so they have their own business, or they're a doctor or a lawyer or similar position where they may be sued because of what they do, a trust provides a barrier there against creditors and predators there. Just flipping onto the next slide, please, Paul. So this slide, from a high-level perspective, is just designed to cover some of the things you may wish to consider for your will. So I mentioned this concept of a testamentary trust. You need to think about, who would be your executor. There's issues around that, where you live in or have assets in both countries. Typically in Australia, for the Australian estate at least, we would want to make sure that it was seen as Australian tax residents. So you need at least one executor who's an Australian tax resident there. I also covered just before the benefits of thinking about including testamentary trusts there. If we just move on to the next slide, that's covered in a little more detail there. So when we're looking at testamentary trusts from an Australian perspective, this is assuming income that's generated from that trust of approximately $50,000. So not a huge amount, but a reasonable amount. If that all went to someone who's on the top rate of tax, so the beneficiary under the will, they're paying approximately $22,000 every year in tax. If conversely, they're able to use a testamentary trust and they say had 3 children or 3 grandchildren, minors are actually treated as adults uniquely from a testamentary trust. They would pay no tax on that because each child gets a tax-free threshold of approximately $20,000. So it's a significant benefit there that which is a reason why we tend to include at least the option of testamentary trusts these days. Moving on to the next slide, please, Paul. So this slide just summarizes some common things to think about either preparing or updating your estate planning, and it's throughout your life really. We always say that it's important to have a will, but you shouldn't just put it in the drawer and forget about it, because there will be things that happen during your lifetime, whether it's having children. That's a very common one that focuses people's attention, is who will look after the children if you're not here, but how is the money looked after, because legally they can't have that until age 18, but people often want to push that out further. Might be changes to families, disputes between parents and children, or children having children of their own. Relationship changes, so for example getting married, a lot of people don't realise that revokes a previous will, so it's important to think about that. But divorce conversely doesn't, so people often don't realise that, but they wouldn't want to their estate going to their ex that they're at war with potentially there. Illness is another common one, again it focuses people's minds there, and superannuation, making sure that's dealt with appropriately. Assets overseas, so summarising here, I'll just go into whether we have separate wills or a worldwide will. So having a worldwide will is easiest in the perspective if you only have to have one will, only if you instruct a lawyer to only deal with one lawyer, which I understand sometimes might be an advantage. But the benefit that is often outdone by the fact that if you only have one will, you would need to get a grant of probate in the country in which you die domiciled. So say if you were in Australia or New South Wales, and then you need to get that then resealed in the UK. And typically the process for obtaining probate takes a couple of months here, and then you need to do the same in the UK. So it can lead to it taking much longer. And also you can, if you have separate wills, you can get that probate at the same time and make sure each is structured best from a tax perspective. So if you have assets of a reasonable value in both countries, we tend to always suggest having separate wills. Investment changes, looking at how those are held, whether it's in your own name or say a trust, for example, and looking at buying and selling real estate. So thinking about what's the best structure there during your lifetime for estate planning, but also asset protection. Do you have it in someone's own name, sole name, or in joint names, or in a trust, for example? Looking at the next slide, please. So I mentioned superannuation in Australia, and it's quite unique when we compare to typical pensions in the UK. And it is much more an estate planning tool here. So it's quite limited in terms of who you can leave it to. And unless you leave it to one of these people, we were suggesting a death benefit nomination, which directs the trustee where to pay it to, the nomination could be invalid and the trustee might not pay it in accordance with your intentions. Fortunately, though, you can pay it to your estate, which means it then passes to your will. And then depending on how your will is structured, it can be held for your family there and longer term and get a better tax outcome. But because it's quite a technical area, it's best to always seek advice onto who you should nominate in terms of those nominations. And there have been cases where they're not done properly and they've been overturned. So as Alan said, it's always good to make sure you do things properly there. Looking at the next slide, please. So I mentioned enduring powers of attorney. These cover decisions in the event of incapacity. So things like operating bank accounts, managing investments, paying bills. It's very important to think about having a tiered nomination as well. If it is, for example, appointing your other half there, what happens if they can't act because they're incapacitated or they're not here? So also thinking about having a further person to make those decisions or persons. Similarly, looking at the next slide, dealing with appointments of enduring guardians to deal with medical and lifestyle decisions, but also we have the concept here of an advanced healthcare directive where you can make certain directions about, say, life support if you want to rely on the doctors more there rather than putting that difficult decision in the hands of family there. So moving on to the next part. So this is where I'm going to focus more on UK assets and some of the common things we look at. So Alan mentioned this concept of domicile, which we have in Australia and the UK. So it not only influences your liability to inheritance tax, it determines what law applies to your assets. So in a nutshell, effectively, if you were to die domiciled, say, New South Wales, because you considered here to be your home, then your worldwide, what we call movable property, which is everything other than real estate, is dealt with by New South Wales law. And if you had, say, a house in the UK, then that would be dealt with by UK law. Fortunately, it's quite similar, but it can create conflicts there. I covered the issue of whether to have separate wills or one worldwide will just earlier, so I'll skip over that there and just move on to the next slide, please, Paul. Looking at inheritance tax, though, it is very important where this applies, where people have moved from the UK to Australia, this is properly considered. And we'll often find that where people don't have the experience on the UK side here, it's often missed because Australia doesn't have inheritance tax, but in other countries it's very much the norm, and it's no longer good the approach that people might have took in the past of putting their head in the sand with all tax in general, because we have the sharing information between tax authorities and financial institutions these days. The other thing, though, that can capture people out, at least from an Australian tax perspective, is what's called capital gains tax event K3, which I call Australia's backdoor inheritance tax. And this is where certain assets are left to someone in Australia to a non-resident beneficiary. Usually the position is that beneficiary, if they were resident here, would inherit the cost base of the asset for capital gains tax. So they don't pay capital gains tax on death. Where we're talking about a non-resident beneficiary, though, that doesn't apply, and capital gains tax is triggered on death in relation to certain assets. So it can cause problems there. You don't get an offset for inheritance tax if that applies either, because they're different types of tax. And it can lead to inequality between beneficiaries if one perhaps receives less because of that tax versus another. A common way, though, of seeking to avoid that, particularly if a beneficiary may return to Australia, is the idea of giving them an optional testamentary trust, because provided there's an ability to have that trust to remain Australian tax resident, it avoids that trigger to CGT. Just moving on to the final slide here. So looking at inheritance tax, some of the common things we may wish to consider doing. So Alan spoke about how this works and the idea that if you're still considered to be UK domiciled, then you're subject to inheritance tax on your worldwide estate, as opposed to if you're acquired a New South Wales domicile of choice, then the difference then is that you're only subject to inheritance tax on your UK assets, which can be significant if, say, you've moved here and built most of your wealth up here. There is an exemption, fortunately, between married spouses, not de facto, but they have to be the same domicile position. So it only kicks on the second death if you're married. But the wills need specific drafting in order to make sure that exemption does apply, because it needs to be an outright gift or a specific type of trust called a life interest trust. We also sometimes see a situation where people have set up trusts in Australia who are originally from the UK, and they've not had the benefit of speaking to someone like Alan who understands it. They've just spoken to their normal accountant who isn't familiar with inheritance tax. Where people do that, unfortunately, the UK also seeks to tax to inheritance tax transfers into family trusts at a 20% transfer tax, inheritance tax in, and 10-year anniversary charges and exit charges as well. One of the common things we do recommend, if you have moved to Australia and really established home here and have been here for at least 3 or 15 out of 20 years, depending on your circumstances, is this idea of what's called a statutory declaration of domicile. It sets out in detail the circumstances of your background and moving here, why you did so, whether it was climate or lifestyle, better place to bring up children, career opportunities, the usual ones. And that is used as formal evidence should HMRC ever dispute your domicile status, particularly after your death, and you're not here to make that argument there. I'll finish up then on the final slides. There are a couple of exemptions, but running short of time there, and also some red flags to think about. So one of the things we also see is where people have moved to Australia and then moved back to the UK, and so they've set up a family trust here. The rules in 2017 changed, and that then captures that trust to UK inheritance tax. There are certain things you can do. Also, a common thing before 2017 was to shelter UK residential property through, say, an Australian trust. That strategy no longer works. So if you're in that boat, just look out for that. So that brings my part of the session to an end. As we mentioned, I work for Hall & Wilcox. So we're just an Australian firm, but we're based around the country with getting on for nearly 1,000 people. And very much happy to help you if you have any questions or need assistance following today's session. We offer an initial no obligation meeting to discuss your circumstances there, and we've got a team around the country on the next slide with my details on that if you have any questions afterwards. With that, sorry, I went slightly over, but I'll pass you back over to Paul. Thank you.
Yeah, thank you, James. Yeah, it's really important to get that inheritance tax piece right. There's been some quite famous cases over the years where HMRC have managed to get tax from estates when to all intents and purposes it looked like somebody had done everything to break domicile. So it's really important to get some professional advice in that area. Okay, so I'll try and get through my bit as quickly as possible because we are running over time a little bit. But I'm from BDH Sterling. I'm a financial advisor, and I specifically help people who are moving between the two countries. So one of the main areas that we look at when we're looking at planning is retirement income planning. So even if you're early on in your working life, obviously, if you're saving for the future in terms of what you're going to put into pensions, your savings, etc., it's some life events as you go along, but the ultimate aim is obviously to be able to retire on a healthy amount, and that's what we concentrate on. So there's some important questions. They seem obvious, but when and where do you want to retire? So, what age are you looking to try to target, and is that realistic? And we can help you to assess that and to assess what you need to do along the way to get to that point. Where do you want to retire? That's really important with the audience today. Is it going to be Australia? Is it going to be the UK? Because that can really change the planning where you're going to position money for the future. What do you want to do in retirement? Are you going to spend some time with family and sitting in your garden reading a book, or are you going to buy a yacht and sail around the world? Obviously, two very different financial situations there. So we need to be careful to ensure that we know exactly what you are going to plan to do, and how long will the money need to last. Realistically, how long is your retirement going to be? So. There are average life expectancies, but most of the time when you do financial planning these days, you run it to age 100. So, if you're retiring at age 55, we need to make sure you've got money for 45 years or more. And also, are you particularly interested in what you're going to leave behind for beneficiaries, etc.? So all of that needs to be factored in. So one of the ways that we do our financial planning is to do cash flow modelling. So in this, we put all of your current situation into a piece of software, and it projects everything forward, so we can see exactly what your financial landscape is going to look like in the future, and most importantly, whether there are some points during your retirement where you may run out of money. And then we can do what we can to try to address that, whether it's just that you redirect investments, for example, put things in different tax wrappers, etc. And we need to build in various different things into that we know are going to happen along the way. We put the example of university fees there, but when I'm talking to my clients, I even talk to them about how often you're going to change your car. These things that need to be factored into a financial plan, so that we know exactly what's likely to come out of it over time, so we can be realistic about what the end result is going to look like. So this just gives you a quick snapshot of what a cash flow modelling looks like on a very basic level. So the top one, you'll see that there's some red on the right hand side, and that basically means that in this scenario somebody is likely to run out of money when they get older, and so their plans as they are might not work. Whereas the bottom one, you'll see there's a bit more activity on the left-hand side, and that's just repositioning assets, and it shows that at the end that there is sufficient money to meet this person's expenses. We can run various different what-if scenarios. Once we've got to this base plan, once we've just projected forward exactly what you've got at the moment and where it's invested at the moment, we can then run what-if scenarios. So we can say, well, what if you retire at age 55 rather than age 65? What if you do buy that yacht and sail around the world? There's various different things that we can build in there to work out what impact that has on the financial situation. And and also then we can test it for various different inflation and investment returns, and stress tested, if you like. Okay, so just looking at various different things that we can do to help you, particularly with the Australia and UK aspect to it. So there are different tax regimes for pensions in the two countries in particular. This can be really important if you're in the UK at the moment but plan to be in Australia in the future, because when you pay contributions into a pension scheme in the UK, you get tax relief on that contribution. You're then in a tax-free environment for your investments over the years. In Australia, you don't really get the same levels of tax relief up front. Your investments are taxed as they go along, but because of that, you get tax-free benefits from a superannuation fund in Australia. Now, having had your tax relief and your tax-free growth in the UK, you could potentially transfer your pension over to an Australian superannuation fund and then get it all tax-free in your retirement. So that tax relief that you got up front from the UK in the first place, and all the investment growth you got on it, is effectively free money. It's a real boost to your savings that you might not get by putting your money elsewhere. You never give it back to HMRC in the UK, so for once you get one over on HMRC. Take your opportunities while you can. Looking at how you go about transferring that in due course, if you do end up back in Australia, you have to do it in the right way. It has to go to the right type of scheme. There are limits on how much you can transfer into Australia in one tax year. We have to think about the exchange rate if you are going to convert into Australian dollars. There is the opportunity, if you've got a particularly large fund in the UK and it's going to take a while to get it over to Australia, there is the opportunity to convert into Australian dollars within a UK scheme and invest in Australian dollars, so that you don't have to wait until later to convert if you want to convert earlier. Okay, so as far as retirement income is concerned, I've talked about drawing money from superannuation, but there could be various different sources of income for your retirement. It's not all about the pension. And this is particularly important if you're actually going to stay in the UK, where pension income is subject to tax. Because you could be drawing a little bit out of your pension that falls within the personal threshold in the UK. You could have some investments where you can realise gains within the capital gains tax threshold as well. There could be you could have money in ISAs that you can draw tax free. You could have money in offshore bonds where you can draw a certain amount out each year tax free. So there's various different sources that you could have that would be actually more tax efficient than drawing from a pension. And the same thing applies in Australia. How do you go about drawing your income? Where is it going to come from? Do you have rental income as well? Is that going to use up some of your personal threshold, and therefore you need to try and limit your tax elsewhere? So it's not all about just drawing from your pension. I know it sounds counterproductive. You've saved for your retirement in a pension, but sometimes it can be more tax efficient to draw from other assets, at least in the short term. Okay, so the state pension, I won't go into too much detail here, but if you ever want to check exactly where you are with the UK state pension, then you can just go on and do a UK state pension forecast. Just Google that, and you'll get to the relevant page. You have to have paid at least 10 years of UK national insurance contributions to get at least some UK pension. You have to pay 35 years to get the full state pension. The difference, if you end up in Australia, then when you get to retirement, your annual pension will not be inflation linked. You won't get those inflationary increases each year, unlike if you were in the UK, where you will get those inflationary increases. So it's something to consider. And obviously you need to know exactly how the age pension in Australia might affect you as well. Obviously the main difference with the age pension in Australia is that it is means tested. Hopefully you'll be way over the means test and in a much better financial position than if you needed to use the age pension. Okay, so I've already talked a little bit about using different investment tax wrappers. I talked about the capital gains tax and ISAs and pensions, etc. So the value of advice, it's a bit of a sales pitch, if you like, for somebody like myself, a financial advisor. But particularly if you're going to flip between Australia and UK in your retirement, then there can be some opportunities there. There can be some pitfalls as well. So getting some professional advice from somebody that can, even if you're living in the UK at the moment and you're planning to be in Australia in the future, just be doing the right planning in the UK at the moment. As I said, there are various things that you can take advantage of that could really work out well for your future. So I've been doing this for 12 years now. I've been in financial services for 27 years, but I've been specifically helping people that are moving to Australia for 12 years. So, and my colleagues are in a similar position. So, we should hopefully be able to help you. We've also got 3 offices out in Australia, so we've got various advisors over there as well. So we can help you on both sides of the world. Okay, so I'm just going to now hand you to Joe from the Australia UK Chamber of Commerce, who's just going to give us a bit of closing remarks, and then what we will do is we will come back then to myself, and I will go through the questions and answers in conjunction with Alan and James.
Thank you, Paul, and thank you to BDH Sterling today. This is a very important topic. BDH Sterling are a very valued member of the Chamber. And of course, this will be a particularly relevant topic given the free trade agreement between Australia and the UK. With the free trade agreement between Australia and the UK, there will be greater movement of people between the two countries. And I think because this is such a very complex area, there will be a lot more demand for advice. I want to thank Paul, Alan, and James for a very informative and relevant presentation today. I can see from the questions that there are many questions. So without further ado, I hand over to Paul to take the questions. Thank you.
Thanks, Joe. So what I'll do is I'll crack on with the questions. We've already got 12 in there at the moment. I haven't had a chance to read them yet, but I'll read them as we go along. And so what I'd say is, just keep on adding your your questions as and when you get them, and we'll try and get through as many as we can. We were slightly over time, but we've got a bit of time to go through these questions. I am conscious that Alan and James are both in Australia, so it's getting a bit later over there than it is for myself in the UK. But we'll go through them now. So the first one is: when I become UK tax resident and continue to benefit from a regular pension and occasional capital sum withdrawals from my Australian superannuation, the whole amount of withdrawal will be taxed by HMRC as income, despite having already been taxed by ATO. Apart from liquidating my super before becoming UK tax residents, are there other strategies to avoid HMRC's double taxation?
Okay. I think one aspect that would be worth looking at in that situation is the availability of what's called foreign service relief in the UK. To the extent that the Australian super was accrued prior to, as I recall, the 6th of April 2017 and pertains to employment in Australia, there may well be some valuable relief there from the charge to UK tax. That's I'm afraid the best one can reasonably do in the UK these days. The UK treats foreign pension funds as if it were a UK scheme. And so there may be a measure of relief, for example, in respect of the tax-free lump sum component. I defer to Paul as to the taxation of UK pensions, but foreign service relief may well come to the aid of the questioner in respect of some of those monies.
Yeah, it's something that we do work with people now who are in the UK and Australian superannuation funds, and working out exactly what can be done with them in terms of whether they can just withdraw the lot and pay little tax on it because of that foreign service relief, and various other different strategies that we can employ to try and limit the tax that is paid on that. So yeah, it's something to really get in contact if you've got some specific questions about that. See what we can do in terms of planning for that. Second one, I have a feeling that the first few are going to be for you, Alan, because they probably came in the order that we were presenting.
Indeed.
If I was to share my time between UK and Australia, will the following strategy work? Spend every other year in UK from the 6th of April 22 to the 5th of April 23, avoiding HMRC temporary non-residents while remaining normally resident and domiciled in Australia, and fulfill the ATO minimum pension withdrawal and any capital withdrawal only while resident in Australia.
Okay. So the questioner is, I think, saying cease to be resident in the UK for a tax year. I think that's what the questioner is asking, and then during that tax year, access the monies from the Australian super. That would appear to work. I'd need to check whether there's any anti-avoidance provisions in the UK legislation. If the individual is resident in Australia only, then potentially that could work. But as I say, I'd want to look at the at anti-avoidance questions in the UK before I was categoric on that as a strategy.
Okay. Deborah Ross, what do you mean by washing out of gains if property bought in the UK before 2015?
Okay. So this is in the context of the disposal of a property in the UK while not resident in the UK. And what I'm saying is that, say one bought a property in 2005, a residential property in the UK, and you sell it when you're not resident in the UK, the UK capital gains tax calculation will not have reference to the original cost of the asset in 2005. It'll have reference to the value of the property in April 2015. And so one is removing or washing out the increase in the value of the property in that period, 2005 to 2015, you're simply referencing the value of the property in April 2015 when you compute the capital gain as a non-resident in respect of the sale of a residential property in the UK. If you're resident in the UK, then you have to look at the original cost of the asset. And yes, there would be some elimination of the capital gain to the extent that it was your main residence, for example. You lived there for a number of years, but often we've had clients with investment portfolios of real property, of real estate, and the act of moving to Australia can quite substantially eliminate capital gains on properties by selling the property at the appropriate time. So that's what I meant by washing out.
Okay, perfect. Thank you. This next one's for me. If super is liquidated before returning to the UK, are there similar investment funds in the UK which provide good returns and security without rip-off fees for a reinvestment of my super? Is it possible to invest in a pension, e.g. SIP, in UK from unearned income? Okay, so in terms of investment funds, yes, you have very similar choices in the UK. Albeit that you'll find that the widest choice that you've got over here is obviously in sterling, in pounds rather than dollars. But yes, you have a wide variety of different things that you can invest in and different providers that will vary in their fees. Different professional advisors that will vary in their fees and the performance that they get for you in that respect. Obviously, one of the things about fees is if you're getting 10% with one provider and paying them 1% per annum, but then getting 5% elsewhere and paying no fee, then you're still net better off with that first one. So it's all about being careful about what you actually get for your money. Now, in terms of investing in a pension from unearned income, the maximum you can do if you don't have UK relevant earnings to back it up is 3,600 gross into a pension scheme. If you do have relevant earnings of 40,000 or more, then you can pay a maximum of 40,000 to a UK pension. There's no I think what you're probably referring to there is whether there's an equivalent of the non-concessional contribution that you have in Australia, where you can contribute from after-tax money, and you're subject to a different limit. There's no equivalent over here in terms of pensions. So it might be a case of putting, if you've got a large amount out of your super, some into a pension this year and then in following years, some into ISAs, some into a general investment account. They can all be invested in the same portfolio, and you just move it from wrapper to wrapper each tax year as you get a new allowance. So that can be really effective. Like for example, if you've got a general investment account and you've got an ISA on the same platform, you could be invested in exactly the same portfolio. The following year comes round, you've got another ISA allowance, and you move over from the GIA to the ISA, just changing the tax wrapper. And that's what we refer to as, well, the industry refers to as bed and ISA. So you put all the money in one place and then just gradually move it into a more tax efficient area. So yeah, certainly if you've got some specific queries there, then speak with me about it, and I'll see what I can do for you. Next from Deborah, do we need to pay tax on Australian super if we reside in the UK, and is this applicable vice versa? Well, we were talking about that a minute ago. If you're drawing from Australian super while in the UK, if you draw from a UK pension as an Australian resident, then you will pay tax in Australia on that UK pension, or at least it'll be subject to tax, depend whether it falls outside the personal threshold over there. So that is something to consider, and particularly if you do have a UK personal pension or a company pension, but you also have UK state pension coming in, then it may well be that the state pension in due course starts eating up most of your personal allowance in Australia, particularly if you've got other taxable things coming in like rental income, etc. So you may well find you pay more tax on that UK pension than you might do otherwise. So that's where it's worth exploring a transfer of a pension to Australia if you're going to be in Australia in the future. where you can draw the benefits tax-free in your retirement, if you're drawing from an Australian scheme, that is. Okay, so Alan, born in UK, how do I ensure my domicile is in Australia?
In fact, I'm probably going to flick that one over to James, because James will, I'm sure, talk about statements of domicile and the acquisition of domicile of choice.
Yeah,
Thanks, Alan. So I'm assuming the attendee, you're in Australia, you're living in Australia now. So the basic test is to show you're permanently and indefinitely intending to reside in Australia, or it's actually state-based. So it's possible actually to move from state to state, and you might refresh your UK domicile and origin. But what you need to do is to try and show evidence that you've acquired that intention to reside here permanently indefinitely. So ideally, the fewer the links to the UK, the better, and showing your kind of centre of existence is Australia. Now, I realise that's not always possible, because you might have, for example, family back in the UK. You might have perhaps retained your old home there as an investment property, other assets potentially there. But having the fewer links to the UK is the better. Particularly because if you don't have assets in the UK, then that you won't be on HMRC's radar in the same sense if you did when you die, and then they may look at your you have to submit an inheritance tax return potentially, and they would look at your worldwide wealth there, and then potentially question, well, you've got a relatively small amount in the UK, but it's all in Australia, and say, well, actually, we don't think you're domiciled in Australia. This is where this statutory declaration domicile can come in. So you're not here to make that argument, unfortunately. So this document is typically a 2 to 3 page document. It's based on historic domicile investigations, and it's used as evidence should HMRC ever dispute your domicile status. Unfortunately, it's no longer possible to get HMRC to give domicile rulings. It used to be possible to go to them. There are very rare exceptions where they'll give that, but even then it's only at that point in time. So our view is it's better to have this formal document in place should it ever be challenged down the track.
Yeah, thanks, James. David, you asked about pension superannuation and it being taxable where you're a tax resident, which we've obviously covered off in a couple of other questions. You said, how does that work in practice? E.g., you're an Australian tax resident, but your salary is paid out of the UK with pension contributions made to a UK pension fund. What I'd say, David, is let's have a chat about that specifically. I know we've spoken before, David, so yeah, maybe we'll have a bit of a chat and discuss specifically how that works, because that won't affect many people. So yeah, probably one to talk about privately. Okay, Stuart, I am domiciled and resident for tax purposes in Australia, having originally come from the UK in 2004. How will inheritance from my parents still in the UK be treated for tax purposes?
You want me to answer that, Paul?
Yes, yep, with you, James.
Yeah, well, Alan as well. So, I mean, in terms of inheritance, any inheritance tax from the UK, if your parents' estate is above their combined nil rate bands, and also this concept of a main residence nil rate band that we have these days, that inheritance will be subject to UK inheritance tax. Quite a common thing that people do in the UK, if their estates are subject to inheritance tax, is to look at potentially making a gift to children. It's what's called a potentially exempt transfer, and provided your parents survive for 7 years from the date of that, then it's outside of the UK inheritance tax net. That depends, if it's worth that way, whether they would be paying inheritance tax anyway, and otherwise, if your parents needed that money whilst they're still alive. Obviously, once you get that money, it's going to impact your income tax and position as well. And if you then died and kept it in the UK, then it's part of your UK estate for inheritance tax purposes there, rather than bring it to Australia. Alan, I don't know if you've got any comments from a more broad tax perspective as well.
I think the main thing is that the Stuart is the act of receiving a gift from the UK. It doesn't immediately affect Stuart. It's an issue for his parents' estate. So sometimes I understand that some jurisdictions have a have tax rules where one pays tax if you receive money from an estate, but that doesn't pertain in Australia.
Okay, perfect. Thanks, guys. So Isaac's got a question about NHS pensions and being told that they can't be transferred to an Australian super. Unfortunately, Isaac, you are right. So in 2015, the UK government brought in flexibility in terms of how you can draw on personal pensions in the UK, which makes them just as flexible now as Australian superannuation funds, albeit that you have to consider tax in the UK and you don't have to in Australia. When they did that, they had a general look at pensions, and they decided that they weren't happy about people transferring out it en masse and trying to enjoy this flexibility elsewhere. One, they were concerned that people didn't really understand what they were giving up, but secondly, they couldn't really afford to pay a whole load of transfer values because these are government-backed schemes and they are not ring-fenced. So they're what's called unfunded public sector schemes. So what we mean by that is you pay contributions, but they go into the general government coffers and they just budget each year according to what they expect to have to pay out for each of these pension schemes. So it's not just the NHS. It is the NHS, the police, the armed forces, teachers' pension scheme, firefighters' pension scheme, and the civil service pension scheme. So those are the 6 unfunded public sector schemes that are affected by that. And it means your benefits will remain in the UK in the future, and when you get to retirement, you will just have to make sure that the scheme knows where you are, so keep them updated with your address, and they will then write to you a few months before you're due to take those retirement benefits to arrange how to do that. Some people like to leave a UK bank account open for the future, so that they can have that income and their UK state pension income paid into a UK bank, and then use a currency broker to exchange into Australian dollars, giving them a better rate on it and better timing on it. But yeah, unless anything changes significantly, then those 6 schemes can't be transferred. Just one thing to note, the local government pension scheme was not included in that list that I gave you just now. It is possible to transfer from the local government pension scheme because they have the local government pension scheme is split into a number of different ring-fenced schemes. Like, for example, you'll have the West Midlands scheme, you'll have the West Yorkshire's pension scheme. You'll have these various different ones, and they are ring-fenced. They work more like a normal final salary type arrangement. Okay, so the next one is why is the list of Australian ROPs approved by HMRC that we can invest our UK pensions made up mainly of small family trusts, none of which you would feel confident investing in? You're able to invest in those schemes. Basically, this was another change that came about back in 2015 when the government was having a wider look at pensions. They looked at QROPs, which QROPs is it's basically a piece of legislation rather than a specific scheme. It's a piece of legislation that allows you to transfer your funds to an overseas scheme, and that scheme then agrees to adhere to certain requirements back to HMRC and to stick to certain rules. Now, one of the things when HMRC looked at these QROPs rules, which have only been in place since 2006, so they have reviewed them gradually over time to ensure that they're working the way that they wanted them to. They looked at Australian schemes and a few other countries, and what they didn't like was that you could draw benefits under the age of 55 in circumstances other than serious ill health. So in UK, it's only serious ill health. Over in Australia, you've got serious financial hardship, and you've got a couple of other circumstances where you might be able to draw benefits early. So HMRC basically removed the QROP status from all of the schemes in Australia. What's happened since is that we've got one retail scheme called the Australian Expat Superannuation Fund that is more like your Prudential or your Aviva or somebody like that you might recognise in the UK as a personal pension, that's been specifically set up for expats. and you can only join that scheme when you are age 55 or above. So it cannot pay benefits to somebody who's under the age of 55 in circumstances other than serious ill health. So basically, you can only join that scheme at that point. That is the only retail scheme at the moment that's done that. None of the other big players decided to go down that route after the rules changed. All of the other schemes are small self-administered schemes, basically self-managed super funds is what it's called, SMSF. So that's why you have all these weird and wonderful names, because people are setting up brand new schemes from scratch themselves, which we help people to do over there. It can be a better option than using that retail scheme for a lot of people. So you can set up these small schemes yourself, and you'll be the only member, or maybe you and your other half will be the only member of those schemes. You're both age 55, therefore you get the QROP status from the UK and you can transfer to it. But yeah, those ones that are already there, they're specifically for those people that set it up. You wouldn't be able to join those ones even if you wanted to. You would need to set up one yourself or join that retail scheme. So sorry, that was a bit of a long answer to that, but I just thought I'd better give you some context as to why the list looks that way. Yeah, certainly something that we can help you with. And as I said, it can be actually quite cost effective as long as it's managed in the right way. Okay. Charles said this is a simple inheritance question, but then I haven't seen what Charles's question actually is yet, so we'll move on to the next one. Shane, my wife and I are about to move to the UK, and her company's pension scheme will contribute 10% when she contributes 5%. It sounds like a good benefit, but it looks like there are very few Australian super funds we can transfer to. Okay, sorry, I've just answered that question about what's available over there. So Brett says, can you clarify, if deemed domicile in UK, resident in UK for 15 of the last 20 years, then on return to Australia as a citizen, you are still potentially subject to UK inheritance tax for another 3 years whilst residence in Australia? Who wants to take that one?
Are you good with that, James?
Yeah, that's fine. So because it's the 15 out of 20 year rule there, it's actually you're going to need to be resident in Australia for 5 out of 5 tax years, UK tax years, potentially, to lose that deemed domicile status. It's not that 3-year period, so it's actually longer than that.
Okay, perfect, thank you. So, sorry, 2 seconds.
You want to answer this one as well?
So yeah, the next one's the other way round to the question that we had earlier. Inheriting money from Australia, do you have to pay UK tax on that inheritance?
The UK won't, provided your mother was domiciled in Australia, and the assets are Australian assets there. So it would just then, increase your UK estate once you had inherited that. The only issue there would be you're in the UK. There is potentially this issue of Australian capital gains tax event K3, but it's not UK tax there. But it kind of finds certain scenarios there.
Yeah.
Okay, perfect. Thank you. And then the next 2 questions are very, very similar to ones that we've already had. So unless you've got anything specific, Charles and the anonymous attendee that asks your questions there, then we'll bypass those ones for the moment.
Yes.
So the next one says, can you keep paying personal contributions into your Australian super while residing in UK? What are the tax implications? It's not so much a case of whether you can, it's whether you should. And whether there's other options that are better for you. I talked earlier about the tax relief that you can get on contributions into a personal pension in the UK or a company pension in the UK. The tax relief that you get that you wouldn't get up front from an Australian scheme. So, it could be worth considering paying the UK one, but it will really, that question really will come down to your personal circumstances, your intentions going forward in the future, the sort of sums of money that you're talking about, what you've already got in your pensions, because there's limits on how much you can transfer, you can put into your pensions in both countries. So yeah, definitely one to get in contact with me about, and we can have a good chat about that specifically for you.
Can I just add?
Yeah, no
Paul,
worries.
that if the individual has got taxable income in Australia, even though non-resident, they may have rental property, rental income they might have sold and realised a capital gain. Then there can then be merit perhaps in making a personal contribution into super to reduce taxable income, even though non-resident.
Yeah, exactly. As I said, it very much comes down to the wider personal circumstances and what's best.
Yes.
It's not a case of whether you can, it's whether you should. Okay. So, Steve, apologies if I do read out very similar questions because I haven't had a chance to read these. Steve says, I have been living in Australia since 2016, although I only informed HMRC last year. I am paying tax via a private pension on my state pension, which has been uplifted because I didn't retire until I was 69. My home is in New South Wales and I have no plans to return to the UK. Do I still need to pay tax on my UK pensions?
So Steve is he's a resident of Australia, and I am assuming that he has a permanent residency visa or is an Australian citizen. Isn't necessarily so. He could have a bridging visa or some other temporary visa. But if we assume he's a permanent resident or citizen, he is subject to tax in Australia on his worldwide income. So yes, the pension income is taxable in Australia and has been since he moved in 2016. We then need to look at the tax treaty provisions. Article 17, I think it is, talks about the fact that pension income is solely taxable in the country in which the individual is resident. So if he's had tax withheld under pay as you earn in the UK, then there's a conversation, some form filling to be done in the UK in order to release back the PAYE that's been withheld since he moved to Australia, because as I say, the pension is solely taxable in Australia.
Okay, perfect. Thank you. Next question is it worth converting a UK occupational pension to Australian super if I only plan to stay in Australia for about 2 years after drawing my super? Do the tax advantages of converting outweigh any inconvenience of transferring funds back on return to the UK? Well, we have to be very careful if people are transferring their pensions over to Australia to know what their intentions are in the future. Because if you were to return to the UK within 5 years of leaving the UK and you'd withdrawn from your Australian super, particularly if it was large amounts, then you could find yourself stuck with a retrospective tax bill in the UK when you return. So if you are going to be staying out of the UK for over 5 UK tax years, then it could be of benefit to you to transfer and draw your funds tax-free in the meantime. But we need to be very careful about that. I'm working with a client that's in exactly that situation at the moment. So we're doing some planning around that. So what I'd say is, maybe again, let's have a chat, talk about your personal circumstances and whether that is a suitable plan for you or not. It can be good, can be bad. Okay, so the next one, UK laws reducing the interest deduction of property. Is there a way to make real estate in the UK a sole trader business, e.g. by owning at least 6 properties, or do you have to own it in a company to achieve this? And if so, does this always result in having to pay stamp duty to transfer, or would a transfer to a trust avoid this?
Okay, I can't see an Australian angle to this question, but so this goes to the question that finance costs are no longer wholly deductible as an expense against rental income in the UK, and they're now treated as effectively a tax credit. The finance costs are tax credit, tax offset at 20%. My immediate reaction is to say that you can only get it by putting it into a special purpose vehicle, a company. to get the full deduction for interest. If the person who's asking the question is a resident of Australia, then the Australian rules would allow for the full deduction of interest against the rental income. But if the questioner is a resident of the UK, it's a UK only question, and I think one would need to look at ownership in the corporate entity to get that full deduction. I always say when people are looking at special purpose vehicles, companies to own property, just be mindful of capital gains as well on the eventual disposal of the property, because there are valuable reliefs available to individuals who own property. There's a CGT annual exemption, for example. If a company sells a property and realizes a capital gain, the company's going to pay corporation tax on the capital gain, and then you've got to get the money out the company, and so you can find yourself with a double tax hit if you're not careful. So I think that's one perhaps for a further follow-up afterwards.
Okay, so the next question is, I don't have PR in Australia as yet, still on bridging visa. Is there a time limit once you get PR to transfer your UK superannuation over to Australian superannuation scheme? Well, no, it isn't. You very often hear people talk about a 6-month rule of you needing to get your funds over to Australia within 6 months or before you become permanent residents in order not to be taxed on it. It's a bit of a red herring, and that it's mainly because the tax that you could potentially pay, particularly in the early days, is going to be very small, and it's not as much of a consideration as making sure that you get your permanent residency, for example, that your plans are going to be to stay there, the exchange rate, various other different things. But also, you might not be age 55 yet. If you're not age 55, then we can't transfer to Australia. I mentioned earlier, you can't get a scheme in Australia to transfer to unless you're age 55 years old. So that might be, if you are in that situation, there might be some work to do with the UK pension in the meantime to ensure that it's set up in the right way and that it maybe gives you access to Australian dollar denominated investments, etc. So yeah, it's one to again discuss. Next question from Charlotte is, if I'm domiciled in Australia but 2 adult children are domiciled in UK, is there some sort of trust structure for when they inherit our estate so that they can be protected from Australian CGT?
Yeah. So there is, in the sense that if you have a testamentary trust created under your will, and provide there's an ability for the trustee, or at least one of the trustees, to be Australian tax resident, it doesn't avoid Australian CGT, but it defers it, in the sense that if those children decide to keep those assets long term in that trust, there's no CGT to pay. It's only when they subsequently sell those assets, or the trustee does, that they would pay CGT at the cost base of that asset. So it's potentially a good way of deferring that. And it also might protect it, depending on how it's structured, from forming part of their estates for UK inheritance tax as well when they subsequently die. So that's another potential benefit. Perfect.
Thanks, James. Next one from Deborah. Is USS unfunded, the University Superannuation Scheme in the UK? No, it is a funded scheme. It is one that we regularly deal with. I am dealing with a client right now that is looking to potentially transfer out of the USS scheme. Yeah, definitely one that we can still help with. That's not a problem. It's only those 6 that I mentioned earlier. Okay, so the next question is one for Alan. When are you liable for the 30,000 charge for using the remittance basis?
So this charge arises when you have been a resident of the UK for 7 out of the last 9 tax years, and you wish to adopt the remittance basis in the preparation of your UK tax return to deal with in respect of your unremitted income. So 7 out of 9 years. Broadly speaking, the tax saved needs to be more than £30,000 by adopting the remittance basis for it to be a worthwhile exercise. But the threshold is 7 years 7 years of tax residency out of the last 9.
Perfect, thanks. So Rod has asked about restrictions on moving certain pension funds over to an Australian fund and the limits on that. Well, I already mentioned earlier there are certain schemes, as I said, the unfunded public sector schemes that you can't. Other than that, there's relatively few restrictions in terms of what can be transferred. It's mainly about whether you should, particularly if you're in what's called a defined benefit scheme. So things like final salary or career average revalued earnings, as they often are these days, those ones where you have an annual pension each year, and it's only when you apply for a transfer value that you find out what the total fund is worth, because you don't really have a fund value up until that point. Now that's very different to an Australian scheme where it will be invested before and probably during your retirement, and you're going to be reliant on investment returns. So it's a case of assessing whether you should transfer from one type of pension environment to another. And yes, we then have to think about the limit. There is a limit of $110,000 per annum that you can pay into an Australian scheme. If you're under the age of 67, you can pay in 3 years worth, so you can pay in 330,000 in one hit, but you wouldn't then be able to transfer another lot for another 3 years, because you've used up the following 2 years allowances. So yeah, there are restrictions in terms of how much you can transfer in. I've already mentioned the QOPs rules earlier. It can get a bit messy sometimes, but that's why we do the jobs that we do. We are very experienced at navigating that and coming up with the right strategies for people. So I regularly deal with people that have over £1 million in their pensions. So obviously that is a strategy of drip feeding funds over to Australia over the years, but it can work out really beneficially for the client. So yeah, Rod, obviously again, feel free to contact me directly and see what I can do for you in your situation. Brian says, if I'm receiving a final salary pension from the UK after returning to Australia, do I have to complete tax returns for both countries?
So if you're a permanent resident or citizen, Brian, once you become a tax resident of Australia, the tax treaty provides that the pension is solely taxable in Australia. So subject to the amount of your pension, you shouldn't have a need to fill in a self-assessment return in the UK, and you should plan on the basis that you will have a need to make a return of your UK pension income to the ATO each year. To get to a point where the pension is being solely taxed in Australia, there is a procedure one undertakes upon return to Australia. There's a form that one completes and submits to the ATO, but the ATO will stamp it to acknowledge that you're in the system. They send it on to HM Revenue, and that leads to the issuing of an NT or no tax PAYE coding in respect of your final salary pension, and you will then receive the pension on a gross basis, no tax paid in the UK, and you will pay your tax to the ATO. Depending on the monies involved, the sums involved, you might have to pay tax quarterly through the instalment activity system, pay-as-you-go instalment system. But in short, tax return in Australia, yes. UK, probably not.
Okay, I'm just going to quickly answer Adam's question. You said, I joined this late, has it been recorded? Yes, it has, Adam, and we will be sending out recording. If you don't get that, just let us know. It should be available within the next 24 hours or so. The next one, I am in Oz and my partner and I are hoping to live in the UK for a few years in the home that myself and my siblings have inherited. When we decide to move back and sell my part of the house, how will bringing the money back affect me?
Okay, so the transfer of the money oughtn't give rise to a tax consequence. It is the sale of the property that is the transaction that has a tax consequence. And so it's likely to be, I think, a capital gains tax issue Whether that is solely in the UK or whether it's in the UK and Australia is determined by where you are residing at the time the house is sold. And this goes to the point I was making earlier. If you've got a choice in when that house is sold, then it might be that it's better to sell the property once you've departed the UK and returned to Australia, rather than selling it when you're in the UK. That's a computational exercise that might be worth looking at in due course.
Perfect, thank you. Ria asks, if you own rental properties in UK and live in Australia, where do you get taxed on rental income? Well, I think you were going through that earlier, weren't you, Alan? That there could be...
Yeah, it could be both. Could be both. It's likely to be both. So there are obligations, there are thresholds under which you're required to enrol in self-assessment in the UK. So if you've got gross rental income of more than £10,000, for example, in the UK, the revenue would expect you to enrol in self-assessment. Even if you've got no liability in the UK, you might have an ongoing entitlement to the UK personal allowance, for example, as a non-resident. So self-assessment annual tax return obligation. If your rental income exceeds the personal allowance, then you might have some tax to pay in the UK. Then we look at Australia. If you're living in Australia, almost everybody fills in a tax return in Australia. So you'd make a return, assuming, again, you're a permanent resident or a citizen, and you're not a temporary visa holder. You would include that rental income on the Australian tax return. You would claim what's called a foreign income tax offset in Australia for any tax you've paid in the UK, and then any balance of liability would be paid to the ATO when you file your tax return over here.
Okay, and then we've got one final question, unless anybody gets in very quickly, that asks about, it says, I'd like to live in the UK from July to January while working part-time in the UK, and then spend the other half of the year in Australia, also earning a small income in Australia. My home and assets are in Australia, and I consider myself domiciled in Australia. Would I be subject to tax in both countries, or would I be eligible to pay tax on both incomes only in Australia, using the remittance basis? Well, that's definitely your bag, Alan.
Okay. I think the first thing we need to look at is the residency of the individual. So it's quite possible, as I say, that I said earlier, you could be resident in the UK and in Australia. If you spend, for example, more than 183 days in the UK, you'd be resident in the UK, and you might be resident in Australia as well. So we then need to go and look at Article 4 of the treaty to ascertain under the residency tiebreaker provisions, where are you treaty resident? And that will drive the question about how your income is taxed. So I'm afraid I'd need to drill down, as I say, into where is there a permanent home, where a centre of centre of vital interest. I think it's going to be a tax treaty driven question before we can get to the point about how specific sources of income are taxed.
Perfect. Thanks, Alan. So that brings us to the end of the questions and answers. So we shall let Alan and James get off and enjoy their evenings over in Australia. So thank you very much for everybody who's attended and stuck around for the questions and answers. It's good to see that you've all got lots of questions about this. As I said, if you want to speak with us specifically, then please get in contact with us. You can contact me at inquiries@bdhsterling.com. Alan?
We have an inquiry form at bdhtax.com on our website. So that is probably the easiest and quickest way. If you have any questions, want a free chat, fill in the inquiry form, we'll be delighted.
Okay, and James?
Yes, feel very free to contact me at James Stop Wiley and WHILEY at Paul and Wilcox with one L .com.au. And thank you everyone for attending.
Yeah, and thank you, Alan and James, for your parts today, and for the Australian UK Chamber of Commerce and the Britain UK Society as well for helping us, for jointly hosting this today. Yeah, so again, thank you very much, everybody, and we shall now wrap up the proceedings. Thank you.
Thank you, Paul.
Thanks very much, Paul. Thank you. Bye-bye.
Bye.
Bye.